Here's something that almost never gets said in finance videos. There's no cost to being wrong with a hypothetical portfolio. Anyone can build a clean-looking allocation in a spreadsheet, record a video about it, and walk away with zero accountability. If it works, great, they look smart. If it collapses, they quietly edit the description and move on. So let me show you something different. This is my actual portfolio. Not a demo, not a model, the real account sitting right now at $446,000, every position, every percentage. And I want to walk you through exactly why I hold what I hold, including the one position most people on the internet would tell you to sell. 6 ETFs, that's the entire system. Not because 6 sounds like a clever number, but because after years of building and adjusting this account, I've found that 6 well-chosen positions, each with a specific job, consistently outperform the kind of over-diversified 12-ticker collection most people end up with when they try to cover everything. Here's where the portfolio stands. In the last 12 months, up 27%. Over the last 5 years, up 155%. And we're closing in on $500,000 with real weekly contributions and real compounding behind it. I'm going to break down each position, what it does, how it's actually performed, and the part most people skip, where it can go wrong. Most people invest in one of 2 ways. They buy VOO, maybe throw in some bonds and call it done. Or they rotate heavily into dividend ETFs for income and feel like they're doing something smart. Neither approach is wrong exactly, but both leave something on the table depending on your situation. Take the S&P 500. Historically, going all the way back to the 1950s, the index has returned roughly 10% per year in nominal terms. Since VOO launched in 2010, the actual annualized return has been closer to 15%. Either way, at 10 to 15% annually, a $100,000 portfolio grows to somewhere between $260,000 and $405,000 in 10 years. That's meaningful. But for someone starting from scratch in their 30s and aiming for real financial independence, that pace can feel slow. And if you're adding weekly contributions the way I do, not a lump sum, the compounding math looks different again. The real question most people never ask is this: what job is each position in my portfolio actually doing right now at my age with my timeline in this type of account? That question changes everything. Let me say something that might sound strange coming from someone who still holds SCHD. Over the past 10 years, SCHD has returned about 13% annually. VOO, over the same period, roughly 15.6%. That gap doesn't sound dramatic, but compounded over a decade, it's the difference between a good retirement and a great one. More importantly, SCHD returned 4.55% in 2023 and 11.66% in 2024, both years when VOO returned 26% and 25% respectively. That's a significant lag when you're trying to build. Now, here's the nuance. So far in 2026, SCHD is actually outperforming VOO. It's become the top-performing U.S. dividend ETF year-to-date as investors rotate away from tech and into stable, income-generating companies during a period of economic uncertainty. That's not an accident. That's exactly what quality dividend funds are built for. So the real story isn't SCHD is bad. The story is SCHD is a tool, and you need to understand when the tool is appropriate. For a taxable account in the growth phase of your investing life, the math gets complicated. I'll explain exactly why in a moment. The system, framework. Let me walk through each one. Position 1, VOO, 20%. The foundation, Vanguard S&P 500 ETF, roughly 500 of the largest U.S. companies weighted by market cap, expense ratio of just 0.03%, essentially free to hold. This is the benchmark. Everything else in the portfolio is measured against it. VOO used to be the only position in this account for about the first 3 years. It's still the anchor, but as the portfolio grew, it made sense to layer in positions that do each something specific rather than just owning one broad index and hoping.
Position 2, SPMO, 30%, largest position. This is the biggest holding in the portfolio now and the one worth spending the most time on. SPMO is the Invesco S&P 500 Momentum ETF. Here's exactly how it works. It holds approximately 100 stocks pulled from the S&P 500, but not 100 largest, the 100 with the highest momentum scores. It measures price performance over the past 12 months excludes the most recent month to avoid short-term noise, then adjusts for volatility. The portfolio rebalances twice a year in March and September. The result over 10 years, a 20.35% annualized return versus VOO's 15.57%. That's a 4.6% annual alpha that has persisted for a decade. In 2024 alone, SPMO returned 45.81%, VOO returned 24.98%. But here's what surprises most people about the risk profile. SPMO's maximum historical drawdown is negative 30.95%. VOO's maximum historical drawdown is negative 33.99%. SPMO, the supposedly more aggressive fund, has historically experienced smaller peak-to-trough losses than vanilla S&P 500. The momentum methodology naturally rotates away from deteriorating sectors before they fully collapse. That said, this is not a smooth ride. SPMO underperformed VOO in 2019, 2021, and 2023, years when mega-cap tech dominated and momentum rotated away from it. If you own this and you're not prepared for years where it lags, you'll make poor decisions at the wrong time. SPMO's top 10 holdings now represent about 51% of the fund. That concentration is both the source of the outperformance and the source of the risk. Position 3, Qqqm 20%. Qqqm is Invesco's Nasdaq 100 ETF, the buy and hold version of QQQ with a lower expense ratio of 0.15% versus QQQ's 0.20%. Same index, same holdings. Invesco created Qqqm specifically for long-term retail investors who don't need QQQ's institutional liquidity. The Nasdaq 100 holds the 100 largest non-financial companies listed on the Nasdaq. No banks, no insurance companies. You get Apple, Microsoft, Nvidia, Amazon, Alphabet, heavily tech-weighted with strong exposure to AI, cloud infrastructure, and biotech. In 2024, Qqqm returned 25.68%. In 2023, it returned 55%, and in 2022, it dropped 32.52%. That last number matters. When interest rates rise fast and speculative sentiment collapses, the Nasdaq falls harder and faster than the S&P 500. You need to know that before you hold it. There's meaningful overlap between Qqqm and VOO on names like Apple, Microsoft, and Nvidia. That's intentional. When a company is in both, you want that concentration. You're not diversifying away from your highest conviction positions just for the sake of visual balance. Position 4, SMH 15%, the VanEck Semiconductor ETF, 25 of the largest US-listed semiconductors, and I want to be precise about US-listed here. Several of the biggest holdings are international companies, Taiwan Semiconductor at 9.79%, ASML from the Netherlands at 5.75%, NXP Semiconductors, ST Microelectronics. This is one of two funds in this portfolio that gives exposure beyond US borders, and that's by design. Performance: 2023 was plus 73%, 2024 was plus 39%, and 2025 was plus 49%. Over the 5-year period, SMH has compounded at roughly 37% annually. Those are remarkable numbers. But 2022 tells the other side of that story. SMH fell 33.5% in a single year. Semiconductors are deeply cyclical. Memory chip oversupply, export restrictions, geopolitical pressure around Taiwan, any of these can crush this fund in a short window. This is not a sleep well at night position. It's a believe the AI infrastructure build-out is a multi-decade story position. Nvidia sits at nearly 19% of the fund by itself. If that thesis breaks down, you feel it immediately at 15% portfolio weight.
5%. In the Defiance Qqqm ETF, This one requires a more precise description than it usually gets. Qqqm doesn't track a pure quantum computing index. It tracks the Blue Star Quantum Computing and Machine Learning Index, meaning the fund requires companies to derive at least 50% of their revenue from quantum computing or machine learning technology. In practice, about 1/3 of the holdings are pure quantum plays, names like IonQ, Rigetti, D-Wave. The other 2/3 are AI and machine learning infrastructure companies. That blend actually reduces the speculative risk somewhat. Pure quantum computing stocks are extremely volatile. Google's Willow chip announcement in late 2024 sent the sector parabolic overnight. Having 2/3 of the fund in more established AI/ML companies provides ballast. At 5% weight, this is a consciously limited speculative position. If the entire position went to zero, the portfolio barely notices. If the quantum AI thesis plays out over 10 to 15 years, 5% compounds into something meaningful. That's the logic. Proportional upside exposure without letting speculation drive the portfolio. SCHD has underperformed VOO on a total return basis over the past decade, about 13% annually versus VOO's 15.6%. I know that, but here's why it stays, and the reason is more mechanical than emotional. This is a taxable brokerage account. In M1 Finance, dividends are set to cash rather than auto-reinvested into SCHD. When the quarterly SCHD dividends hit, the platform redirects that cash toward whichever position is most underweight relative to its target allocation, which means SCHD is functioning as a rebalancing engine, quietly generating cash that flows into the growth positions when they've drifted below target. And worth noting, so far in 2026, SCHD is the top-performing US dividend ETF as investors rotate out of tech. Those years of being the drag look different when economic conditions shift. Here's something worth pausing on, and it's not what most people notice. Over the last 10 years, SPMO has delivered a 20.35% annualized return versus VOO's 15.57%. That 4.6% annual difference sounds modest until you model it. A $100,000 investment in VOO over 10 years at 15.57% becomes roughly $430,000. The same amount in SPMO at 20.35% becomes approximately $685,000. That's a $255,000 difference from the same starting capital, just from a different methodology within the same index universe. But here's the part that should give you pause. SPMO's AUM has grown from around $300 million to over $16 billion in the last 5 years. Most of that growth came in 2024 and 2025 after the AI-driven outperformance. When that much capital chases a factor strategy, the prices of the stocks that strategy selects get pushed up faster, which can erode the very alpha the factor was supposed to capture. That doesn't mean SPMO stops working. It means you should understand why it has worked before assuming it continues indefinitely. Factor premiums can compress when they become widely arbitraged. That's not a reason to avoid the position, it's a reason to hold it as part of a diversified allocation, not as a replacement for everything else. 5 years ago, this account was a single VOO position with a Monday morning contribution and a long-term number in mind. That's still the core of what this is. The 6 ETF structure came later, once the portfolio had enough size that the allocation choices actually moved the needle. Before that, the only thing that mattered was staying consistent and not stopping during the years that felt uncomfortable. The path from 0 to 500,000 looks boring from the outside. A weekly transfer, a rebalance every few months, a few adjustments when the thesis for a position changes. That's it. No big moves, no clever timing. But that consistency applied over enough time is what turns 100,000 into 446,000 and 446,000 into whatever comes next.